The math behind trading is something most people get completely wrong, and it's costing them thousands of dollars without them even realizing it. You see someone online bragging about turning $500 into $50,000, and you think that's the goal. You think that's what trading is supposed to look like. But here's what nobody tells you. The people who consistently make money in the markets aren't the ones swinging for the fences. They're the ones taking small, calculated trades that win more often than they lose. And there's actual mathematics behind why this works. Let me start with something that might sound counterintuitive. When you risk less money per trade, you actually increase your probability of long-term success. Not because small trades are safer in some vague emotional sense, but because the mathematics of risk and probability literally favor smaller position sizes. This isn't opinion. This isn't trading philosophy. This is pure statistics, and once you understand it, you'll never look at trading the same way again. Think about it like this. If you have a $10,000 account and you put $5,000 into a single trade, you're risking 50% of your capital. You need to be right. There's no room for error. The market doesn't care about your analysis or your confidence level. If that trade goes against you, you've just lost half your account. Now you need to make 100% return just to get back to where you started. That's not trading. That's gambling with mathematical odds stacked heavily against you. But what if instead of risking 50%, you risk 2%? That's $200 on a $10,000 account. Suddenly, you can be wrong 4 times in a row and you've only lost 8% of your capital. You're still in the game. You still have ammunition. You haven't blown up your account because of a bad week. This is where the math starts to get really interesting. The concept we're talking about here is called risk of ruin, and it's one of the most important mathematical principles in trading that almost nobody discusses. Risk of ruin calculates the probability that you'll lose your entire trading account given your win rate, your average win size, your average loss size, and the percentage of your account you risk per trade. Professional traders and quantitative analysts use this formula to determine optimal position sizing. Retail traders ignore it completely and wonder why they keep blowing up accounts. Here's a simple example to illustrate the point. Let's say you have a trading strategy that wins 55% of the time. That's actually pretty good. You're winning more than you're losing. Your average winning trade makes you 1.5%, and your average losing trade costs you 1%. Sounds reasonable, right? Now let's run 2 scenarios. In scenario 1, you risk 10% of your account per trade. In scenario 2, you risk 2% of your account per trade. With 10% risk per trade, even with a 55% win rate, your risk of ruin over 100 trades is somewhere around 30%. That means there's a 3 in 10 chance you'll lose your entire account, even though your strategy wins more often than it loses. Why? Because the volatility of large position sizes creates sequences of losses that can wipe you out before your edge has time to play out. You might lose 3 trades in a row, which takes you down 30%, and now you need to make 43% just to break even. Then you lose 2 more trades, and suddenly you're down 50%, needing to double your money. The math becomes impossible. But with 2% risk per trade, your risk of ruin drops to less than 1%. Same strategy, same win rate, same average wins and losses. The only difference is position size. That's the power of understanding the mathematics. Small trades don't just feel safer. They are mathematically, provably, statistically safer. Now let's talk about something called the Kelly criterion, which is a formula developed by John Kelly at Bell Labs back in 1956. It was originally designed for long-distance telephone signal noise, but it turned out to have profound applications in gambling and trading. The Kelly criterion tells you the optimal percentage of your bankroll to bet on each trade to maximize long-term growth while minimizing risk of ruin. The formula itself is pretty straightforward. Kelly percentage equals win rate minus the quantity loss rate divided by win-loss ratio. So if you win 60% of the time, lose 40% of the time, and your average win is 1.5 times your average loss, you plug those numbers in and the Kelly criterion tells you to risk about 13% of your account per trade. Now here's the catch. Most professional traders will tell you to use half Kelly or even quarter Kelly because full Kelly is extremely aggressive and doesn't account for estimation errors in your win rate and win-loss ratio. What does this mean in practice? It means even the mathematical formula designed to maximize your growth tells you to keep your position sizes relatively small. If full Kelly says 13% and professionals recommend half Kelly, you're looking at 6.5% per trade maximum. And many successful traders go even smaller than that, risking between 1 and 3% per trade. These aren't scared traders. These are traders who understand that longevity in the markets matters more than home run trades. Let's dig deeper into why small trades win more often from a psychological and execution standpoint. When you risk a small percentage of your account, something interesting happens to your decision-making process. You're not emotionally attached to the outcome of any single trade. You know that even if this trade loses, it's not going to materially impact your account. This emotional detachment allows you to follow your trading plan more consistently. Contrast this with risking a large percentage of your account. Now every tick matters. Every small move against you creates anxiety. You start second-guessing your analysis. You exit winning trades too early because you're afraid of giving back profits. You hold losing trades too long because you can't accept the psychological pain of taking a large loss. Your discipline evaporates because the stakes feel too high. This is why traders who risk too much per trade often have worse execution than their strategy would suggest. The psychological pressure of large position sizes degrades their performance. There's also a mathematical concept called the law of large numbers that heavily favors small, frequent trades. The law of large numbers states that as you increase the number of trials, your actual results will converge toward the expected value. In trading terms, this means that if you have an edge in the market, you need enough trades for that edge to express itself. If you're taking massive positions and can only afford to take 5 or 10 trades before risking ruin, you haven't given your edge enough opportunities to play out. Randomness dominates over small sample sizes. But if you're taking small positions and you can take 100, 200, 500 trades, now the law of large numbers is working in your favor. Your actual win rate will start to approximate your expected win rate. Your average wins and losses will stabilize around their expected values. The noise of randomness gets smoothed out over time, and your edge becomes visible in your equity curve. This is why professional trading firms focus so heavily on position sizing and trade frequency. They understand that edge plus volume equals profit, but only if your position sizing keeps you alive long enough to see the statistics play out. Here's another piece of mathematics that people overlook. It's called volatility drag, and it's the hidden killer of aggressive position sizing. Volatility drag refers to the mathematical fact that percentage losses hurt more than percentage gains help. If you make 10%, you're up 10%. But if you then lose 10%, you're not back to even. You're down 1%. Why? Because the loss applies to a larger base. This asymmetry gets worse as your gains and losses get larger. If you gain 50%, you're up 50%. But if you then lose 50%, you're down 75% from your peak. You need to make 100% just to get back to even. This is the mathematics that destroys traders who take large positions. They experience high volatility in their account equity, and that volatility creates drag that prevents them from achieving the compounding returns they think they're going to get. Small trades reduce volatility drag. When your account goes up 2% and then down 2%, you're basically flat. The drag is negligible. Your equity curve is smoother. Your compounding is more efficient. You spend less time trying to recover from drawdowns and more time in growth mode. Over the long term, this makes a massive difference in terminal wealth. A trader with a smoother equity curve and lower volatility drag will often end up with more money than a trader with higher average returns, but higher volatility, even though the second trader has better nominal performance. Let's talk about drawdowns specifically, because this is where the math becomes really stark. A drawdown is the peak to trough decline in your account equity. If your account goes from 10,000 to 7,000, that's a 30% drawdown. To recover from a 30% drawdown, you need to make roughly 43% on your remaining capital. Already, the math is working against you. But it gets worse. If you experience a 50% drawdown, you need to make 100% to recover. If you experience a 75% drawdown, you need to make 300%. The deeper the drawdown, the more impossible the recovery becomes. And here's the key point. Large position sizes create large drawdowns. It's not a matter of if, it's a matter of when. Markets are volatile. Losing streaks happen. If you're risking 10 or 20% per trade, a normal losing streak will create a catastrophic drawdown that you may never recover from. Small position sizes keep drawdowns manageable. If you're risking 2% per trade, Even a brutal losing streak of 10 trades in a row only draws you down about 18%. That's psychologically tolerable and mathematically recoverable. You need to make about 22% to get back to your peak, which is entirely achievable with a decent trading strategy. You haven't destroyed your account. You haven't destroyed your psychology. You can continue trading with confidence. Professional traders think in terms of risk-adjusted returns, not absolute returns. The Sharpe ratio is a common metric that measures return per unit of risk. A strategy that makes 50% per year with 20% volatility has a Sharpe ratio of 2.5. A strategy that makes 80% per year with 60% volatility has a Sharpe ratio of 1.33. Which is better? Most professionals would prefer the first strategy because the returns are more consistent and predictable. High volatility might give you bigger gains in good times, but it also means bigger losses in bad times, and the psychological toll of that roller coaster is immense. Small trades inherently create better risk-adjusted returns. By limiting your position size, you limit your volatility, which improves your Sharpe ratio even if your absolute returns are lower. And here's the thing that most retail traders don't understand. Lower volatility allows you to use more leverage if you choose to. Professional trading firms often use significant leverage, but they combine it with very small position sizes per trade. They might have 20 or 30 positions on at once, each risking a tiny fraction of their capital, but in aggregate creating meaningful returns with manageable risk. This is sophisticated portfolio construction, and it's only possible when you think in terms of small, diversified bets rather than large, concentrated positions. There's also a concept in mathematics called ergodicity that applies here. An ergodic system is one where the time average equals the ensemble average. In simple terms, this means that what happens to one individual over time is similar to what happens across many individuals at one point in time. Trading is non-ergodic when you take large positions. If you blow up your account, your personal experience ends. You're out of the game. It doesn't matter that across all traders, some succeed. Your individual path has terminated. Small position sizing makes trading more ergodic. By keeping your risk of ruin low, you ensure that you stay in the game long enough for the probabilities to work themselves out. Your personal time average has a chance to converge with the ensemble average. You get to participate in the long run, where your edge actually matters. This is why survival is the first rule of trading. You can't compound returns if you're not around to make the trades. Let me give you a concrete example with real numbers to make this crystal clear. Imagine two traders, both with $10,000 accounts. Trader A risks 10% per trade. Trader B risks 2% per trade. They both use the exact same strategy with a 55% win rate. And when they win, they make 1.5R, meaning 1.5 times their risk. When they lose 1R, meaning exactly their risk amount. Over 100 trades, we'd expect trader A to win 55 times and lose 45 times based on the 55% win rate. Their wins make them 1.5 times 10%, which is 15% per win, for a total gain of 825% across 55 wins. Their losses cost them 10% per loss, for a total loss of 450% across 45 losses. Net result? They're up 375%. Their account is now $47,500. Sounds amazing, right? But here's the problem. This assumes perfect distribution of wins and losses. In reality, losing streaks happen. If trader A experiences just 5 losses in a row at any point, their account drops by 40%. Now they're trading with $6,000 instead of $10,000. They need 67% returns just to get back to even. If they hit another losing streak later, the damage compounds. In practice, the volatility of 10% risk per trade means trader A has a very high probability of experiencing a devastating drawdown that either takes them out of the game psychologically or mathematically. Now let's look at trader B. Same strategy, same win rate, but risking 2% per trade. 55 wins at 1.5 times 2% equals 3% per win, for a total gain of 165%. 45 losses at 2% per loss equals a total loss of 90%. Net result? They're up 75%. Their account is now $17,500. That's obviously less than trader A's theoretical maximum, but here's the crucial difference. Trader B's worst-case losing streak of 5 trades in a row only draws them down about 9.5%. They're trading with around $9,000. They need about 11% to get back to their peak. This is entirely manageable both mathematically and psychologically. Trader B is virtually guaranteed to still be in the game after 100 trades, with a smooth equity curve and healthy account balance. Meanwhile, Trader A has a significant probability of having blown up or taken catastrophic damage to their account. When you extend this over thousands of trades, the advantage of small position sizing becomes even more pronounced. Trader B compounds their gains steadily with minimal volatility drag. Trader A, even if they survive, experiences massive swings that create drag and psychological damage. Over the long term, Trader B likely ends up with more money despite lower nominal returns per trade. This is the mathematics that professional traders understand and retail traders ignore. It's not sexy. It's not exciting. You can't brag on social media about making 3% on a trade. But over time, consistent small gains with minimal drawdowns will beat spectacular gains interrupted by spectacular losses. Every single time. Without exception. There's also an important concept called sequence of returns risk. This means that the order in which you experience wins and losses matters a lot when you're compounding. If you take large losses early, you have less capital to compound when the wins come. If Trader A experiences their losing streaks early in their trading career, they might lose 50 or 60% of their account before their edge has a chance to play out. Now they're trying to compound from a much smaller base. Trader B, with smaller position sizes, is more resistant to sequence of returns risk. Whether the losses come early or late, the impact is manageable. Their compounding isn't interrupted by catastrophic drawdowns. This is why starting with small position sizes is especially important for newer traders. You need to survive long enough to gain experience and for your edge to manifest. Large position sizes create a high probability that bad luck early on will end your trading career before it begins. Let's also address the psychological appeal of large trades, because understanding the math isn't enough if you can't control the emotional desire to swing big. Humans are wired to prefer lottery tickets over steady accumulation. We'd rather have a small chance at a massive gain than a high probability of a small gain, even when the expected value of the second option is higher. This is called prospect theory, and it explains why people play the lottery, gamble in casinos, and take oversized positions in trading. The problem is that markets don't care about our psychological preferences. The mathematics of compounding favors consistency over volatility. A trader who makes 2% per month every month for a year ends up with 26.8% returns thanks to compounding. A trader who alternates between making 10% and losing 8% ends up with worse results despite the higher nominal gains, because the losses create drag and interrupt compounding. Breaking free from the psychological desire for home runs requires understanding that trading is a marathon, not a sprint. Your goal isn't to get rich on the next trade. Your goal is to still be trading in 5 years with a steadily growing account. Small trades keep you in the game. They allow you to learn from mistakes without catastrophic consequences. They give your edge time to play out. They create the psychological stability needed for consistent execution. Another mathematical advantage of small trades is that they allow for better diversification. If you risk 10% per trade, you can realistically only have 2 or 3 positions on at once before you're over-leveraged. This means your results are heavily dependent on a small number of trades. If those trades don't work out, you're in trouble. But if you risk 2% per trade, you can have 5, 10, or even 20 positions on at once across different markets, time frames, and strategies. This diversification reduces your overall portfolio risk through a mathematical concept called correlation. If your trades are not perfectly correlated, meaning they don't all win or lose at the same time, your portfolio volatility decreases. This is the mathematical basis of modern portfolio theory. By spreading risk across multiple small positions, you get smoother returns with less overall risk. Professional traders and hedge funds use this principle extensively. They're not trying to hit home runs on individual trades. They're constructing portfolios of small, diversified positions that collectively generate consistent returns. There's also a practical advantage to small position sizing that relates to market impact and slippage. When you trade large size, you move the market against yourself, especially in less liquid markets or instruments. You pay wider spreads. You get worse fills. Your actual execution price differs from your intended price. This slippage eats into your returns and makes it harder for your edge to overcome transaction costs. Small trades minimize market impact. You can get in and out at better prices. Your transaction costs as a percentage of position size are lower. Your actual returns more closely match your theoretical returns. Over thousands of trades, this difference in execution quality adds up to significant P&L. Here's something else to consider. Small position sizing gives you the flexibility to scale into and out of positions. If you use your entire risk budget on one entry, you have no room to add if the trade moves in your favor or if you get additional confirming signals. But if you start with a small position, you can average in if your thesis strengthens or cut quickly if you're wrong. This dynamic position management is only possible when you start small. Professional traders often enter with a fraction of their intended position size, then add as the trade proves itself. This pyramiding approach maximizes gains on winning trades while keeping losses small on losers. But it requires starting with small positions. If you go all in immediately, you've lost this flexibility. The mathematics of trading also involves thinking about your trading edge in terms of expectancy. Expectancy is the average amount you expect to make per trade. It's calculated as win rate times average win minus loss rate times average loss. If you have a 60% win rate with average wins of $300 and average losses of $200, your expectancy is 60% times 300 minus 40% times 200, which equals $100 per trade. Now here's the key insight. Your total expected profit is your expectancy times the number of trades you can take. If your expectancy is $100 per trade, taking 100 trades gives you $10,000 in expected profit. Taking 1,000 trades gives you $100,000. The math clearly favors volume when you have positive expectancy, but volume requires survival. You can only take those 100 or 1,000 trades if you manage your risk properly. Large position sizes limit your volume because they create risk of ruin. Small position sizes maximize your volume by keeping you in the game indefinitely. Once again, the mathematics points in the same direction. Small, frequent trades with positive expectancy beat large, infrequent trades, even if the large trades have higher potential gains. Let's talk about the concept of maximum adverse excursion, which is a quantitative tool for analyzing trades. ME measures how far a trade moves against you before it either stops out or moves in your favor. By analyzing the MAE of all your trades, you can determine optimal stop-loss placement and position sizing. What the data consistently shows is that trades with smaller position sizes relative to volatility have better recovery rates. If you risk too much relative to normal market movement, you get stopped out of trades that would have eventually worked. If you risk an appropriate amount based on the mathematics of volatility and MA, you stay in more winning trades while still controlling risk. This is another mathematical argument for smaller trades. By right-sizing your positions based on market volatility and ME statistics, you improve your win rate. You don't get shaken out of positions prematurely. Your edge has time to play out. But this only works if you're not over-leveraged to begin with. If you're risking 10% per trade, you can't afford to give trades room to breathe. You need tight stops, which means higher probability of getting stopped out by noise. We should also discuss the concept of optimal F, which is another position sizing model developed by Ralph Vince. Optimal F is the fraction of your capital that maximizes the geometric growth rate of your account. Like Kelly, optimal F tends to produce aggressive position sizes that most traders should reduce for practical purposes. But the mathematical exercise is useful because it shows you the theoretical maximum risk you should take, which you can then scale down based on your risk tolerance. What's interesting is that even at optimal F, which is designed to maximize growth, the recommended position sizes are typically much smaller than what most retail traders use. If the mathematically optimal aggressive strategy says to risk 8% per trade, and most professionals recommend using half or quarter optimal, we're back to 2 to 4% risk per trade. The mathematics, no matter which model you use, consistently points towards smaller position sizes than intuition suggests. There's also an important point about mental accounting and the house money effect. Research shows that people take bigger risks with money they've won than with their original capital. This is irrational from a mathematical standpoint. A dollar is a dollar regardless of where it came from. But psychologically, traders often increase their position sizes after winning streaks, which is exactly when they should be most disciplined. Small position sizing provides a guardrail against this psychological trap. If you have a rule that you never risk more than 2% per trade, it doesn't matter if you just made 10 winning trades in a row. You're still risking 2% on the next trade. This consistency protects you from giving back your gains during inevitable losing streaks that follow winning streaks. The math of trading is ultimately about playing defense. It's about protecting capital first and growing it second. Every professional trader will tell you that their primary job is to not lose money. Making money is secondary. This seems backwards to most people, but it's mathematically sound. If you don't lose money, compounding takes care of growth over time. But if you take large losses, you create mathematical holes that are difficult or impossible to recover from. Small trades embody this defensive mathematics. They ensure that no single trade, or even a series of trades, can seriously damage your account. They keep your drawdowns shallow and recoverable. They preserve your capital for the long term. And in trading, the long term is where all the money is made. Consider the example of professional poker players who understand these mathematical principles intimately. They don't go all in on every hand. They carefully manage their bankroll, typically risking no more than 1 to 5% on any single tournament or cash game session. They know that poker has variance and that even the best players experience downswings. By keeping their risk small relative to their bankroll, they ensure they can play through the variance and let their skill edge produce profits over time. Trading is the same game with different pieces. You have an edge or you don't. If you have an edge, you need volume and survival to extract profit from it. Small position sizing provides both. If you don't have an edge, no position sizing strategy will save you, but at least small trades let you lose slowly enough to figure that out before you've destroyed your account. The final mathematical concept I want to discuss is the idea of trading as a negative-sum game after transaction costs. Every trade you make incurs costs including commissions, spreads, slippage, and potentially fees. These costs are unavoidable and they come out of your returns. If your edge before costs is small, transaction costs can turn a winning strategy into a losing one. Small trades help mitigate this problem in an indirect way. By forcing you to be selective and disciplined, small position sizing tends to reduce overtrading. You're not taking marginal setups just for action because you know each trade needs to count. This selectivity means you take fewer trades, pay fewer transaction costs, and focus on the highest probability opportunities. The mathematical result is that a higher percentage of your gross edge translates into net profit after costs. Large position sizing, conversely, often correlates with overtrading and poor selectivity. Traders who are willing to risk 10% on a trade are often the same traders taking mediocre setups out of boredom or compulsion. They pay more in costs and their edge gets eroded. Small position sizing encourages the discipline that protects your mathematical edge from being consumed by costs. So where does all this mathematics leave us? The conclusion is clear and consistent across every model, every principle, and every example. Small trades win more often not because they're inherently better trades, but because they allow your edge to express itself over sufficient volume while protecting you from ruin. They reduce volatility drag. They keep drawdowns manageable. They preserve your psychology. They allow for diversification. They minimize market impact. They enable dynamic position management. They protect against sequence of returns risk. They enforce discipline. The mathematics doesn't lie. Professional traders, quantitative analysts, and successful long-term market participants all converge on similar position sizing recommendations. Risk between 1 and 3% per trade for most strategies. Use proper Kelly sizing or risk of ruin calculations. Focus on risk-adjusted returns, not absolute returns. Prioritize survival and consistency over home runs. If you take nothing else from this, understand that your position size might be the single most important decision you make as a trader. More important than which market you trade. More important than your entry and exit rules. More important than your indicators or chart patterns. Position sizing is the difference between long-term success and eventual ruin. The mathematics proves it. The statistics confirm it. The professional track records demonstrate it. Small trades win more often because mathematics favors consistency, survival, and volume. Master the math of position sizing, and you've solved half the trading puzzle. Ignore it, and you're fighting an impossible uphill battle against probability itself. The choice, as always, is yours. But now you know what the numbers say.